All right, welcome back to the deep dive. Today we're going to take a deep dive into the world of retail option trading.
Sounds good.
Now, when most people think of options, they probably picture like, seasoned Wall Street guys in suits,
Right.
making big bets. But things have changed like a lot. Like since the pandemic especially, this whole market has just exploded. I mean, we're talking a 35% increase in volume just between 2020 and 2021.
Yeah, that's right. Huge, huge growth.
Yeah, and get this, they estimate that retail traders, regular people like you and me, now account for over 60% of all option trading.
It's mind-blowing, right? It's really a whole new landscape. And I think for a lot of people, it's kind of hard to wrap your head around what's really going on.
Yeah, for sure. You see these headlines about like, is it just reckless gambling or is it like, this new democratization of finance? We wanted to get past those simple narratives and really like dig into what's actually happening. And luckily, there's some really interesting research out there that allows us to do just that.
Yeah, for sure.
And so for this deep dive, we're going to unpack a couple of academic papers. And what's cool about these papers is one of them gives us this really close-up view of individual traders and how they behave.
Yeah.
It's looking at trading journal data from over 5,000 retail traders between 2020 and 2022. So it's kind of like looking over their shoulder and see what they're actually doing, their actual trades, their actual results.
Yeah, like really getting in the weeds, huh?
Yeah, for sure. And then the other paper takes this wider angle, looking at complex options trading using real market data.
Right.
And it zeroes in on what happened after this big shift to zero commission trading, which is a big deal.
Huge, yeah.
So we get this like detailed individual perspective and a broader market view.
Yeah, love that.
And by like putting those two pieces together, we're going to try and answer some key questions, for all of us, like how are everyday investors actually using options?
Yeah.
What kind of strategies are they trying? Are they making money? And are there any kind of like unexpected things happening in the market because of this huge surge in retail trading? So those are kind of the big questions that we're going to dive into today.
I love it. Sounds like a good plan.
Okay, so let's start by just like really getting a sense of the scale of this boom, right? I mean, we said there's a lot of growth, but the numbers are really pretty staggering.
Yeah.
I mean, the Options Clearing Corp, they reported that 35% jump in volume between 2020 and 2021. But to really put that in context, the researchers, Brizgalova, Pavlova, and Sigurskaya, they estimated that retail trading has made up over 60% of the total options market volume recently.
Yeah, it's just massive.
It's a huge chunk.
It is a huge chunk. And it's not just the trading activity itself that's changed, but if you think about it from the broker's perspective, the companies that offer brokerage services to retail investors, they're seeing a bigger piece of their revenue coming from option trading now compared to stock trading. So you can imagine with this rapid growth, there's some natural concerns that arose. I mean, you probably heard some of these worries about people taking on too much risk, maybe not understanding exactly what they're getting into.
Oh, for sure.
And the possibility of really big losses, especially as you have more and more people who aren't necessarily professional traders getting into these sometimes pretty complex financial instruments.
Right. And so with that in mind, with this like picture of rapid growth, but also some understandable concerns, that's where this first paper comes in.
Mm-hmm.
They really did a deep dive on how these retail option traders are actually behaving.
Mm-hmm.
And what I think is really interesting is where their data comes from. They didn't just rely on, estimates or surveys. They actually got data from this company that provides trading journals.
Yeah.
I was kind of curious, like, how does that even work?
Yeah, I mean, that's what makes this research so powerful, right? It's not just hypothetical, it's real world data. So these trading journals, they're basically tools that help traders track their performance and analyze their trades. And what's really cool is that users can voluntarily connect their brokerage accounts to the journal. So like TD Ameritrade was mentioned as an example.
Okay.
So they link their account and then all of their trades are automatically imported into the journal. So it's verified data. They're not just cherry picking their winning trades or anything like that. It's the real deal.
Oh, wow. That's cool.
Yeah, it's pretty neat. And so with that, they were able to analyze the data from over 5,000 traders who made almost 1 million option trades. So you're really getting a very detailed look at what's actually happening in the market.
So what did they learn about, like, why these people are trading options? Is it, are they using them to protect their stock holdings? Are they making like sophisticated moves to reduce risk?
Yeah, that was one of the big questions, right?
Yeah.
Are they hedging?
Yeah.
And for the most part, the answer is no. What they found was that the main goal for these retail option traders is short-term speculation. So they're trying to profit from quick price movements, not really hedging or reducing risk in their portfolios. And the typical trade, according to the data, is buying short-term call or put options, often linked to the S&P 500 index. And they hold these positions for incredibly short periods, often just a few hours.
Wow, hours. That's intense.
Yeah, it's like day trading, but with the added leverage and time sensitivity that you get with options.
Yeah, wow. So what about whether they're mostly buying or selling these options?
Well, they found that option purchases far outnumbered sales
Okay.
by about a 7-to-1 ratio, which again makes sense if you think about their goal. They're speculating. So typically when you buy an option, you're opening a new bet. When you sell, you're usually closing an existing one. And this trend towards super short-term trading is actually getting even stronger. They saw the average time until these options expire, it dropped from 4 days in 2020 to less than a day in 2022.
Wow.
Options that expire on the same day that they're bought, sometimes called zero DTE options, those became really popular.
0 days to expiration, yeah. It's wild.
Yeah.
I mean, that's like the option just vanishes at the end of the day.
Yeah, it's a high-stakes game, high risk, high reward.
Yeah, for sure. So the paper also looked at why people might choose options instead of just buying or selling the underlying stock. And they talk about this idea of affordability.
Yeah?
Can you kind of unpack that for me a little bit?
Yeah, so, it's another piece of the puzzle. They found that retail investors often see options as a cheaper way to play the price swings of those really high-priced stocks. Like imagine a company like Tesla before it did its stock split. To buy even one share, it would cost hundreds of dollars, maybe even thousands. But a call option on Tesla might only cost a fraction of that.
Right. So it's like getting leverage on the stock's direction without having to put up the full share price up front.
Exactly. It's like a more affordable way to get exposure to those potentially big moves.
Right. And the paper even looks at what happens after a company splits its stock, making the individual shares more affordable.
Yeah. That's really interesting, right?
Yeah.
They found that once a stock becomes more affordable after a split, you actually see trading in the actual stock increase relative to its options by about 10%. So that really suggests that that high share price was a barrier for some of these retail traders, pushing them towards the options market. But here's the kicker. This trend held even for traders who, based on their other trading activity, could likely afford to buy multiple shares of the higher priced stock.
Interesting.
So it suggests that there's maybe some kind of psychological or budgeting aspect at play.
Right. So they're speculating, they're doing it on these short-term price movements, often in, well-known stocks, big indexes, and they're using options as this more budget-friendly way to get involved. But the big question is, are they making money doing this?
Right. The million-dollar question. Right.
Yeah.
And, well, on average, the answer is no.
Okay.
They found that the average return on these retail option trades was negative of 0.9%.
Ouch. So they're losing money.
So basically, for every dollar they invested, they got back about 99.1 cents on average.
Not a great track record.
Not great.
What does the distribution of those returns look like? Is it like, are there a few big winners that are kind of skewing the overall picture, even though most people are losing?
That's a good question, and what they found was pretty interesting. The distribution of returns for option trades was pretty balanced, with a slightly negative skew. So for people who bought options, the 10th percentile, they were losing about $296, while the top 10% gained about $217.
Okay.
So while there are winners, the losses on those worst performing trades tended to be a bit larger than the gains on the best performing ones.
Okay.
And what they noticed with individual traders over time, for both their options and stock trading, there was this tendency towards more frequent small gains and less frequent but larger losses.
Interesting.
Yeah.
So why is that? Why do the losses seem to outweigh the gains over time, even though, in theory, options can offer these like really big outsized returns, right?
Yeah. It's a bit of a paradox, but the researchers point to a couple of key reasons for this. The first is those super short time frames they're trading on, which we talked about. And the second is this pretty common behavioral bias. Traders often tend to take profits relatively quickly on winning trades, but they'll hold on to losing positions for much longer, hoping they'll turn around.
Right.
So even though they might be hoping for those huge skewed payoffs, their actual trading behavior often leads to the opposite outcome. Cutting winners short and letting those losers run.
Yeah, classic mistake.
Yeah.
So it's tempting to just lump all retail traders into one big group. But the paper did highlight that there's actually quite a bit of variety in how they approach trading, right?
Oh, absolutely. They found a wide range in how long people hold on to their options, from less than an hour to several weeks. And the frequency of trading also varied a lot, from under 7 trades per month to over 50. So there's definitely different styles at play. And they made a point to emphasize that their main findings, like the focus on short-term speculation and those average losses, they held true across different types of traders. So whether you looked at how active they were, the size of their trades, how long they held them, even which brokerage they used, the overall trends were pretty consistent.
Yeah, that's good to know, that it's not just like one small group.
Right.
It seems like there's like a broader pattern here.
Yeah, definitely.
What about the types of assets that they were trading? Like, are they spreading their bets across lots of different stocks and options?
Not really, actually. What they found was that the retail option trading was heavily concentrated in just a few popular names,
Okay.
mainly the big stock market indices like the S&P 500 and well-known high-priced tech stocks. But on the other hand, their stock trades were much more spread out across a broader range of mostly lower-priced stocks. And another interesting point is that they rarely combined their option and stock positions in the same underlying company.
Oh, interesting.
So they were kind of treating those two activities, stock trading and option trading, as separate things.
Okay. And how did the profitability of their stock trades compare to their option trades?
Well, on average, their stock trades basically broke even. The returns were symmetrically distributed, so the potential for gains roughly matched the potential for losses,
Okay.
which again is a big contrast to those consistent losses that they saw with their option trading.
Yeah.
And to break it down a bit further, the vast majority of their option trades, about 87%, were what we call long positions, meaning they were buying options rather than selling them.
Gotcha.
When it came to individual stocks, they favored buying call options, so bets that the price would go up, over put options, which are bets that the price will go down. But for index and ETF options that flipped, they preferred puts over calls.
Interesting.
And generally, they lean towards options that were trading at or just slightly above or below the current price of the underlying asset. So those are called at the money or slightly out of the money options.
Right. Makes sense. Now, let's talk about leverage for a minute, because options are kind of famous for offering a lot of leverage. You know, you can control a large amount of stock with a relatively small amount of money.
Right.
Were these retail traders actually using a lot of leverage, taking on a lot of risk?
Yeah, that's an important question. And when you look at the returns they got on these option trades relative to the amount of money they put in, it does show high leverage. But when the researchers calculated the overall leverage they were actually using, taking into account the total dollar amounts being traded, it was only moderately higher than what you typically see with people trading stocks on margin. So it's somewhere in the range of 1.3 to 2.5 times their initial investment.
Okay.
So while the potential for high leverage is there, their actual trading didn't necessarily translate into extreme levels of leverage across the board.
So it's like the potential is there, but they're not necessarily going crazy with it.
Right.
Okay. And the paper also mentioned this idea of limited evidence of skewness seeking in their actual dollar profits.
Yeah.
And we kind of touched on this before with that negative skew. It seems like they might be hoping for those big, rare wins, but they're not quite getting them.
Yeah, exactly. Their behavior doesn't really align with that goal.
Right. And what about those like really complex trading strategies? Are these folks using, multi-leg options or combining stocks and options and strategies like covered calls?
Well, that was another kind of surprising finding. Those more complex strategies were actually pretty uncommon among these traders. Things like covered calls, where you own the stock and sell call options against it, or protective puts, where you own the stock and buy puts as insurance. Those weren't frequently observed. So it seems like most of this retail option activity is concentrated on those simpler, shorter-term bets on whether the price will go up or down.
Okay, so we've got this really detailed picture of how they're using basic options.
Yeah.
Single leg options.
Yeah.
This is based on this really cool trading journal data. Now, I want to switch gears a little bit to that second paper we talked about, the one that looks at what happened to complex options trading when we got rid of commissions.
Yeah, zero commissions.
What did they find?
Well, this research, which was using actual market data from exchanges, they also found a huge surge in complex option trading by retail investors right after these platforms started offering zero commission trades.
Okay.
The total dollar amount traded in complex options actually peaked at $1.6 billion per month in early 2020.
1.6 billion? That is a lot of money.
Yeah, it's a big number.
Wow. And they specifically focused on Robinhood, which, kind of famously was one of the companies that made commission-free trading really popular.
Yeah, they were a big driver of that.
So how do they actually measure that?
So they used a method called a difference in difference analysis, which essentially helps to isolate the impact of a specific event, in this case, zero commissions, by comparing it to a control group. So they compared the change in complex option trades on Robinhood to what was happening with other stocks after the zero commission policy was implemented.
Okay.
And what they found was that there was a really significant increase, 75.4% in the number of complex option trades, and a 43.5% increase in the total volume traded specifically on Robinhood compared to the broader market.
Wow.
So that really suggests that getting rid of commissions was a major factor in this increased activity in these more intricate option strategies.
So it's like, you take away the cost.
Yeah.
Suddenly people are like, let's try this stuff.
It's get complicated, exactly.
Yeah. What kinds of complex options were people particularly drawn to?
So the paper pointed out a preference for strategies that tend to have high price volatility, built-in leverage, and what they called lottery-like features.
Okay.
And by lottery-like, they mean the potential for really huge payouts if the price moves in just the right way, even if the chances of that happening are pretty small.
Right. So it kind of ties back into that whole chasing those big skewed returns.
Exactly.
But now with these more sophisticated, well, maybe not sophisticated, but at least, more complicated instruments.
More moving parts.
Yeah, exactly. The paper also mentioned this spike in these complex options trading around the time of company earnings announcements.
Oh, yeah, that was another key finding. They saw this noticeable jump in complex options trading around the time when companies released their earnings reports.
Yeah.
And it accounted for a pretty significant chunk of the total trading volume during those periods, like 12 to 28%. And this included both strategies designed to bet on which direction the stock price would go after the earnings announcement, and strategies aimed at profiting from the expected increase in price volatility around those events.
Makes sense. Everyone's trying to, predict what's going to happen.
Right.
So how did these complex option trades actually perform for retail investors, on average?
Okay. Well, not great, unfortunately. They found that the average returns were significantly negative, which probably isn't a huge surprise given what we know about the complexity of these strategies. They estimated an average loss of 16.4% over a 3-day holding period.
16.4% in 3 days. That's a big hit.
That's a big hit, yeah.
Yikes. So it sounds like maybe people weren't, fully aware or prepared for the risks involved.
Yeah, it's easy to underestimate the risks with these more advanced strategies.
Especially when there's no commissions, right?
Right.
Yeah, you don't see the money leaving your account immediately.
Exactly. It can feel less real.
Yeah. The researchers, they also looked at what these traders expected would happen with future price volatility, right? Like what their expectations were.
They did, yeah. So by analyzing the prices of these complex options, they were able to get an idea of what the market was implying about future price swings, especially around those earnings announcements. And what they found was a significant tendency for retail investors to be way too optimistic about how uncertain things actually were. They seemed to be consistently overestimating how much those stock prices would likely fluctuate.
Interesting. So overestimating uncertainty. You'd think that would lead to maybe being more cautious?
Yeah, you might think so, but it seems like the allure of those potential big gains maybe outweighs those concerns.
Right. And could this kind of overestimation of uncertainty, could that be related to how these trading platforms are designed? The paper mentions this idea of gamification, right?
Yeah, I mean, they do suggest that the way these platforms are set up with their user-friendly interfaces, very visual, and the immediate feedback you get on potential gains and losses, combined with no commission fees, it could contribute to this feeling of ease and maybe downplay the risks involved. They also point to the role of something called payment for order flow, or PFOF, which is significantly higher for options trading than for stock trading.
Yeah, payment for order flow. We hear that a lot, even with just regular stock trading. How does it specifically affect the options market?
It's a big factor. What they found was that a disproportionately large amount of this payment for order flow actually comes from option trading, not just stocks.
Okay.
So, for example, in 2021, brokers in the U.S. received about $2.4 billion in payment for order flow for options trades, compared to $1.3 billion for stock trades.
Oh, wow. So more money is flowing from options.
Yeah, significantly more. And it gets even more interesting because this payment for order flow for options is highly concentrated among just three major market makers: Citadel Securities, Susquehanna International Group, and Wolverine Securities.
Okay, so what exactly is this payment for order flow? Just to make sure everyone's on the same page.
Sure. So it's basically when your broker receives a small fee from these market makers, these big firms, for directing your trades to them for execution.
So the broker gets paid to send your orders to a specific firm.
Exactly.
That seems like it could create a bit of a conflict of interest, right?
Yeah, there's definitely potential for that. While brokers are supposed to seek the best possible execution price for their clients, often through competitive price improvement auctions on the exchanges, the reality is that those bid-ask spreads, the difference between the highest price a buyer is willing to pay and the lowest a seller is willing to accept, those tend to be wider in the options market, especially for those short-term and out-of-the-money options that are so popular with retail traders.
Right.
And these wider spreads mean that even though there are no commissions, the indirect cost of trading can be pretty substantial, and it might not be so obvious to the investor.
Yeah, so even if you're not paying a commission, you might be getting a worse price when you actually buy or sell.
Exactly. And that effectively becomes a hidden cost.
Right. Now, the first paper we talked about also brought up this payment for order flow and used this specific market data flag called SLIM to identify potential retail trades. Can you explain that?
Yeah, so the SLIM flag, it stands for Single Leg Price Improvement Mechanism, and it's basically an indicator that a trade in a single option likely got a better price than the prevailing market quote.
Okay.
So it's often used as a proxy to identify retail orders because those are the ones that typically go through these price improvement auctions. And that first paper used the SLIM flag to kind of validate their trading journal data, showing that it was representative of typical retail order flow.
Okay, so they were just kind of checking their work.
Right, making sure it aligned with the broader market. But the second paper, the one we're talking about now, they actually used the SLIM flag extensively in their analysis. They found that the volume of trades going through this SLIM mechanism increased significantly, along with the overall increase in payment for order flow in the options market.
Okay.
They also found that among these SLIM trades, retail investors showed a really strong preference for buying call options over puts, and mostly traded options that were at the money or slightly out of the money.
Okay, so were these SLIM trades, these likely retail trades, were they profitable? The ones that were getting this supposed price improvement?
Well, when they looked at the aggregate level across all these SLIM trades, what they saw was actually losses for retail investors over various holding periods. They estimated that retail investors lost about $1.2 billion on these SLIM trades between November 2019 and June 2021. And that's not even counting other trading costs.
Well,
when they factored in the estimated indirect trading costs, the difference between the price they got and the midpoint of the bid and ask prices, that total cost went up to $5.2 billion.
$5.2 billion? That's a massive number.
It's huge and significantly higher than what they would have paid in direct commissions, even if they were trading with brokers that still charge them.
Wow. It really makes you think about what free trading really means.
Right. There are always costs involved one way or another.
Yeah, for sure. Now, one last thing I wanted to touch on. The paper also looked into this really specific trading strategy called the dividend play. Can you explain what that is and how retail activity might be influencing it?
Yeah, so the dividend play is basically this type of arbitrage strategy that aims to profit from situations where call options are not exercised before the underlying stock pays out a dividend.
Wow.
So, when a stock pays a dividend, the price typically drops by roughly the amount of that dividend.
Right.
And for someone holding a call option with a strike price above that post-dividend stock price, the option might end up being worthless.
Gotcha.
So arbitrageurs try to take advantage of this by buying those cheap call options, exercising them just before the dividend's paid, and then they pocket a small profit from the difference.
Right. So it's like they're taking advantage of this little inefficiency in the market.
Exactly, or a lack of action by other option holders.
Okay. And how does retail trading fit into this picture?
Well, what they found was that arbitrageurs actually weren't taking advantage of all the potential profit in these dividend plays. They were leaving about 50% of the available arbitrage profit on the table, which is pretty unusual for what should be a relatively low-risk strategy.
Okay. So why are they leaving money on the table?
Well, they noticed that these arbitrageurs seem to avoid the dividend plays, specifically in contracts that had seen a lot of buying pressure from retail investors in the week leading up to that dividend payment.
Okay, so if there was a bunch of retail buying of a specific call option,
Huh.
the arbitrageurs were less likely to jump in and try to profit from the dividend play.
Exactly. And they have a theory about why that might be.
Okay?
So the researchers suggest that it's because the big market makers, the ones that dominate the payment for order flow, they're likely the ones selling those call options to those retail investors.
Right.
And if those retail investors don't exercise their options, especially if the stock price drops after the dividend, the market makers get to keep the premium they collected when they sold the option in the first place. So it becomes less beneficial for them to engage in the dividend play in those specific contracts where there's a good chance those options are going to expire worthless anyway.
Right. So they're happy to just let the retail traders kind of lose out.
Yeah, essentially. And the really interesting thing is that other market participants seem to follow suit.
Oh, wow.
They also tend to avoid those same contracts, effectively allowing the big market makers to keep those potential profits.
It's like they're influencing this whole other part of the market indirectly.
Yeah, exactly. Their presence has ripple effects.
Wow. But the research also found that overall arbitrage activity was actually higher in options that were popular with retail traders, right?
Yeah, that's another layer to this. So they found that the arbitrager activity, measured by the amount of trading they were doing on the exchange floor, was positively correlated with the overall level of retail investor trading, as indicated by that slim share, in the week before the dividend. So this suggests that the arbitrageurs are looking at contracts that are popular with retail investors as potential opportunities for their dividend play strategies.
Right, like they're looking for situations where maybe less experienced traders aren't going to act optimally.
Right, potentially.
Okay, so to kind of wrap up this whole deep dive, it seems like the retail options market is a really dynamic and often surprising place. We've seen this massive increase in trading, largely driven by short-term speculation, often in those affordable but potentially costly short-dated options. And then zero commissions have definitely led to more trading in complex options, but the data shows that on average, these strategies are resulting in some significant losses for retail investors.
Yeah, it's a complex landscape for sure.
Yeah. And underneath it all, you've got these market mechanisms like payment for order flow and even those arbitrage opportunities that are being subtly shaped by the trading patterns of retail investors.
Exactly. It's all interconnected. Hopefully, this deep dive gave you a much more in-depth understanding of all the forces at play here. You know, we've gone beyond those simple narratives to look at the actual behaviors, the profitability, and some of the less obvious costs that can affect retail traders.
Yeah, for sure. And it brings us to this kind of final question for everyone to think about.
Yeah.
Based on all this data, all this research, are the current structures and regulations in the options market really doing enough to protect retail investors? Are there things that need to change? Are there hidden costs and complexities that need a closer look? And ultimately, what does this tell us about the real cost of free trading?
Yeah, those are the big questions to ponder. This deep dive is really just the beginning of exploring this constantly evolving market. We'd encourage you to keep learning, think critically about your own investment approach, and always try to get a deeper understanding of any financial instrument you choose to use.
Yeah, knowledge is power, especially when it comes to investing.
Absolutely.
Okay, thanks for joining us on the Deep Dive. We'll see you next time.
See ya.